All right, we'll get started. Good evening. We are Group C, otherwise known as Cam and Fly Company. This is an assessment of our company's performance over the last 15 years, an analysis of our competitive advantage, and a summary of our plans for the next few years. We will begin by analyzing some of the key performance indicators of our progress over the past 10 years. First, we'll start with net revenues. Our net revenues increased for both product segments from year 5 to year 12. After year 12, total net revenues began to level off around the $700 mark. The height of our revenues for UAV drones was in year 15 at 404,000. The height of our revenues for action capture cameras was in year 13 at 313,000. For our EPS, or earnings per share, overall, it increased yearly from year 5 to year 15. This was one of our main focuses during the past 10 years. Our goal was to increase the earnings per share by at least 5% each year, and we were able to meet that goal every year. Our earnings per share was the highest at year 15 at $11.11. Our ROE, or return on equity, for Cam and Fly increased overall as well, but started to level off around year 11. Despite this, we were able to outperform our peers in year 12, 13, and 14, having the highest ROE in the industry during those times. We were able to get the return as high as 60% in year 14, but then it decreased to 55% in year 15. Our credit rating has been stable for the past 10 years. We were able to maintain an A rating for most of the time by keeping our debt percentage less than 20%. We project that we will maintain an A rating in the upcoming years as we continue to finance our operations mostly through equity. Our stock price continues to grow year over year despite the small decrease in year 15. We were able to increase our stock price from $37 per share to $253 per share during our time as co-managers for the company. If our strategy is maintained, we hope to raise the stock price to $300 per share in the next 5 years. Finally, our image rating had some fluctuations throughout the past 10 years. We were able to reach a high of 82 in year 13 and 14, but our current image rating lies at 78. We had some trouble outperforming our competitors in this section, but we hope some new initiatives introduced in the next few years will help to combat this. Next, we'll move on to our strategic vision as a company. It's listed here on the screen and describes who we want to be. Cam and Fly strives to become the industry leader in both action capture cameras and UAV drones. We attempt to accomplish this by providing the lowest cost in the industry for our top-of-the-line products. We reinvest in our shareholders and give the most that we can to all people involved in the company. We are a friend to the environment and dedicate ourselves to environmental sustainability as much as we do to our competitive sustainability. Our performance targets for the next 2 years are listed below. Overall, we would like our company to continue its long-standing growth and overtake market share in our efforts. We would like to maintain at least an 8% growth in our EPS, ROE, and stock price, but our ultimate goal is to get a 10% growth in our stock price and EPS and a 9% growth in our ROE. We would like to get our image rating back up to 82, as it was in year 14, and then maintain that rating for the next few years. Our credit rating will most likely remain at an A.
Good evening, everyone. This is Kopa. So for the AC camera, our company offers a best cost provider strategy. Actually, we are not the cheapest, but we provide the best AC camera in the market with the best price. So we keep costs at a minimum and offer the best PQ rating. So we increase our warranty period in 180 days for our customers. So we wanted to ensure that they feel safe with our product. Our company provides like similar strategy for all of the 4 regions with some discounts and advertising. And our product quality is higher in the market than our other competitors. As we can see from the graph, our cameras have greatly dominated like North America, Europe, Africa, Asia Pacific, and Latin America. And for the UAV drone, our company adopts the low-cost provider strategy, and our strategy helps us to have a good performance over the year. So our company applied this strategy because it has a significant low operating cost than the selling cost. So for the average retail price across 2 of the 4 regions is lower than the selling price. So it's suitable for us to apply a low-cost provider strategy to attract customers in such regions. So for our production strategy, the most important thing was to have robotic upgrades as early as possible, which can help us to save the labor cost and increase production. Another part of our production strategy was to have incentive bonus, attendance bonus, and fringe benefits to keep the worker satisfied. Our productivity improvement training cost for the AC camera is $1,250, and for the drone is $5,250. So those production strategy helps us to compete in the market.
Good evening, this is Maria. So for the strongest and closest competitor in the AC cameras, we chose company D. The pictures shown below are for year 14 and 15 in North America, but in the other regions like Europe, Africa, Asia Pacific, and Latin America, company D has been relatively close to us other than any other company. In areas that they're really close to us would be retail outlets, advertising budget, the website display, and our demand for the AC camera units was higher than company D for both year 14 and 15, but they are still really close to us in the other regions as well. And the UAV drones, for this one, it was kind of competitive because we decided to do year 14 and 15 because for the UAV drones, in the past 3 years, we have been close to company D, company A for year 14, and company E for year 13. So we were kind of deciding on that one, but for the drones, we chose company A as the closest and strongest competitor. And once again, they're really close on online retailers and discount on the online retailer, the product quality rating and website display, and the drone unit demand as a total. For our finance strategy, we usually attempt to repurchase, the maximum amount of stock each year. And the reason we do that is to decrease the shareholder investment in the company. And it also offers more returns on the investors of the company. We want to also focus on maintaining our low cost because we have been the lowest cost provider in the area. Then we also want to increase our net profit, because we feel like it will also increase our earning per share. And then finance our company's operations by equity instead of debt to maintain a high credit rating. The budget for research and development for both cameras and drones to see how we can enhance our product for the lowest price. We will also enact the enhancement of our product over the next 3 years and adjust the price of each product based on the enhancement to increase the product quality. And we will also increase the discount and periods. We'll also increase our discount and the period of weeks of the discount that will be available to our customers' retention. And the retention customers are important because of the cost of acquiring new customers.
We learned so much about crafting a winning strategy from these past couple of years. The first and perhaps the most important lesson we learned was that a winning strategy doesn't just happen overnight. It takes much trial and error, and sometimes we notice that the strategy wouldn't succeed or fail until years later. Our advice to others in this situation would be to take a few years to learn the industry and see what your target market is responding to before changing your strategy. We also learned that all factors of the industry must be considered when crafting your strategy. We tended to focus early on increasing one key performance indicator per year instead of focusing on the entire big picture. We also learned the hard way that all competitors must be closely examined and should not be underestimated. In the final years, Group D or Dynamic Views changed their strategy and overtook some of our market share. Before then, we did not consider them a close competitor, so we did not examine their strategy. We also learned that we should be looking at the industry trends instead of focusing on our company by itself. Industry trends turned out to be a great indicator of consumer demands. Finally, we learned that debt can be a good thing if used properly. We were big on not taking out any loans and only financing our company through equity. Unfortunately, that caused us to miss out on some advancement opportunities that could have generated more income. Our advice to future managers on this issue is to take risk if your company is in a good financial position and always reinvest in your company.
Overall, Cam and Fly has been successful, and we have made significant growth over the years, and we'll continue to perform research to expand our growth as a company and enhance our product at the lowest price possible.
That is the end.